So tonight we're going to do a something called the Anthony video, and I'll explain that in a minute or two, and then we'll start with get back into the Chapter 7 handout. We might finish this handout tonight. I'm not sure, but anyway, so the Anthony video. It's a video about fraud, and one of the things that is intriguing, I think, about fraud is that it's not what people think. You know, people think that there's the evil people going, "Oh, let's do evil things" and all that, and it's a lot of things are very different than that. There was I think it's still one of the largest cases in history. There's a company called Parmalat. It's a European company that had all kinds of, they were in all kinds of different things. They're a conglomerate, and they had a big fraud. It was $10 billion. It was way bigger than Enron or WorldCom in the United States. But one of the things that came out of it was that there was 78 auditors indicted anyways with fraud. I don't know how many of those got stuck or whatever, but 78. So the question is, okay, you know, I was an auditor, and you know, I know a bunch of auditors. How do you get 78 bad apples? You know, and you know, the answer is very different than what you might think. So, you know, it's one of those things that's like, it's just intriguing. Like, oh, well, how could you have this many people? And by the way, the Parmalat fraud went on for years. And you know, the question is, how do you get that many people doing bad things? You know, how do you get what was probably in the hundreds of people doing this? You know, how does that come about? Why, you know, how did that happen? So anyway, this next case, it's actually two things. It's a fraud case, but it's also a brother-in-law case. Anthony's my brother-in-law, and he was in the video you'll kind of see he was doing very well in business and moving up, and he got tangled up with a bad company, and this is kind of his story. It's a little old now. It's been edited many times. It's about 30 minutes. I think he talked for about, it was over 2 hours. So this has been edited down. It's kind of choppy in some places. But anyway, this is him, you know, telling his story, and you kind of get a feel for how stuff like this comes about. All right, so let me see if I can share screen. Okay, I think this is, how do you do it? And I'm going to go ahead and mute my mic and see if you guys can still hear me, or see if you can still hear the documentary. It's got some weird music playing. Again, this is fairly old, but I'm going to mute.
Sure. It's part of the story. I was answering an ad in a newspaper after I graduated from college, and started off as low as you can start. They had probably 2,000 stores worldwide at that time, but just a few here in the U.S. They had just started. Started out as an assistant manager, became a manager, a district supervisor. They were growing fast. They needed young, energetic people, and ended up in their purchasing department, which was a great steady position, corporate level position, didn't have to move around, and was responsible for negotiating. At the end of my 16 years there, it was over $1 billion of merchandise a year, and I was one of many people there. It was a very large organization, which has only grown since I left. But it was privately held, and that's the key to one of the things I wanted to talk about today. I had my whole corporate experience in a privately held company. One family owned it. It's a company that managed its expenses very wisely, never spent an extra penny on anything they shouldn't be spending a penny on, and they bought product correctly. You could negotiate in good faith with vendors. They knew that what you agreed to verbally was going to happen, and very importantly, at the end of the day, that their invoices were going to be paid on time. If you agreed to pay $1 for a bottle of vegetable oil, that's what you would get paid. You would always get paid on time. Aldi is a company that has operated that way and grown and been incredibly profitable doing that. The business model is very simple. Buy low, sell it at a fair price, hopefully lower than everybody else, and make your thin margin in the middle and grow off of that.
Decided that maybe you would leave there.
That's a very good question. One thing about Aldi is that they are so structured. There's a very clear corporate ladder that you climb. As an assistant manager in a store, you become a manager, then you become a district supervisor of 5 stores, and then you hit this director level. I had progressed through the first 3 up to the director level in about 5 years, which was about normal in those days as they were growing fast. Once I became a director of purchasing,
I'm going to step this for 1 second. I did something really stupid. There's actually a handout for this. And so the handout looks like this. So you can kind of fill it in as you go. So there should be something it's either in the it should be in the email. Oh, in the email, by the way, I sent out the second one. The first one I sent out that was labeled as a PDF really wasn't a PDF. I was lying. But the second one I sent out is. So anyway, and these are also in Blackboard. So you can fill this out as you go. So it's called the Anthony Fraud Video, or Anthony Handout, I guess is what it's called there. But anyway, so there is a thing to kind of fill out as you go. Okay. Back to something more interesting.
I did that for 12 years, or 11 years, let's say. And the vice president that was over my department was the same age I was. There really wasn't much room for advancement for me at that point. So I could comfortably be a director for the rest of my life, always do the same thing I always did. You know, in my late 30s, thinking if I'm ever going to make a change, you know, that was the time. Got contacted out of the blue by a recruiter for Fleming, and they were serious. And the numbers they talked about were, you know, they asked me what it would take, is what it got down to. So I could negotiate a salary that was very comparable to what I had. And one thing that I had never experienced, I mean, they were a publicly traded company. They offered me these things called stock options. And that was an incentive as well. Fleming stock was trading at about $11 a share at that time, and had good prospects to go up. And you know, here I was, somebody that had worked in a publicly traded environment, very close knit, didn't talk to a lot of other retailers, and there was a real player out there, probably a Fortune 100 company at the time, billions of dollars in sales, easily 4 or 5 times the size of company that Aldi was, and they were serious. They had the right package, and also something that I had never experienced was a bonus. You know, they would match his salary and offer a bonus. I was actually hired away to start a chain of stores very similar to Aldi. Originally, the purchasing office for this new chain of stores was going to be here in the Chicago area, so I got to stay here. When I originally negotiated it didn't involve a move. I knew it could happen, but they allowed me the freedom to set up the corporate buying office for this little chain of stores anywhere we wanted. And fortunately, one of the executives responsible for this program at Fleming lived in the Chicago area. He wanted to stay also. So we set up an office in Northbrook, and I worked out of that office for a little over a year before it closed. It was a cost-cutting measure to close that and take all of the purchasing into their corporate office in Texas. And it was something that I always knew might happen, and it made sense. Fleming had actually moved its entire company, and this is significant later when you find out why people inside a large organization do what they do. Everybody from Fleming moved from the previous corporate headquarters in Oklahoma City to Louisville, Texas. The whole company moved. They leased a huge warehouse space. It was like an industrial park, and it became the corporate office for Fleming. But everybody working for Fleming in 2001, 2002, until they went bankrupt in 2003, were located in Lewisville, Texas, and nobody was there originally. That's significant when you think of the pressure on people to produce numbers and why there were accounting lapses in the end that led to the downfall. The first meeting I had with Mark Hanson, and talk about why you would make a change, going from a little privately traded company, getting flown on a corporate jet down to have dinner with the CEO, and he's got this vision for a new store. And I asked him how he was going to fund this. I knew Fleming had a lot of debt, over $1 billion in debt, even though they were a large company. I said, how are you going to finance these new stores? He said, well, we've got $450 million in free cash flow. There's plenty of cash out there to open stores. I was very naive. I should have understood that anybody that's dipping into their free cash flow to fund new projects, not the best place to find the money. But there was a lot of money out there, and we did get 17 stores open. And again, they were going along well enough that they thought my services were better used managing all of the private label procurement for Fleming. The reason for that is that they said, well, how are these guys with 17 stores buying a lot of items for a lower cost than what Fleming, this $15 billion wholesaler, is buying for? How can this little group get lower cost than the large group? And it's all comes down to that culture and business practices. I had learned at Aldi that you make your deal, you negotiate for the lowest everyday price you can. There's no funny money involved with that negotiation. Just get down to the lowest everyday cost you can. At Fleming, everything was funny money. You'd have an elevated list cost that you were charged for something. There would be all sorts of allowances that were negotiated below that list cost, and that's where they got in trouble. This gap between what the list cost was and what the true cost was and what it needed to be. It took a lot of energy for the buyers to negotiate that. It was a whole different mindset for them. So they said, look, the guys that are running Yes Less know how to handle private label. We're going to let them be vice presidents of private label for all of Fleming, and they'll buy for the whole wholesaler. So when I went down there, that's what my new position was, as vice president of private label. It was 2 weeks until as I'm sitting in meetings, these guys were not good business people. That gap between a list cost and what you actually pay got exaggerated, and these guys were masters at manipulating that so that a company could report earnings when it bought product instead of when it sold product. And that really is what led to Fleming's downfall. Here's the Wall Street Journal article from September 5th, and this is the last time I'll hand something up. September 5th, 2002. It explains exactly what was going on with the vendors. It's a very accurate article because the main source was another vice president that worked several offices down from me. He left the company. He couldn't stomach it any longer. And he had an axe to grind, and a friend at the Wall Street Journal. And the information's 100% accurate. I have a lot of respect for the Wall Street Journal. It was a front page article, and it was 100% correct. The folks at Fleming and the culture there was that if you needed money to hit your earnings, you could always go back and deduct from the vendors. That was the mindset. Make a deduction. And from an accounting side, we had a controller in our group, and he would always sit there and shake his head and say, no, we can't do this, we can't do this. And somehow at the end of the day, you finally rework the language until it gets done and it gets booked. It's a few months after I got down there, Fleming signed up their biggest retail group ever. It was Kmart. Fleming supplied them all of the groceries and consumables in their stores, which is paper products, health and beauty care, soaps, detergents, things like that. A significant piece of business, about $3.5 billion as I recall. We negotiated for it. Had an internal project that nobody could talk about. They called it Project Blue, which everybody figured out as soon as you said the name from the old blue light specials. But they negotiated for that business, gave Kmart an incredible deal to supply them with all of those grocery products and consumables. My goal in that private label piece was now to make a program work with suppliers that could supply Kmart, could supply Fleming, and could supply the Fleming-owned retail group. All three, and the Fleming private label group. So we had to make everybody happy. ice cream was a big deal. Ice cream's the largest frozen category. There's more dollar sales in ice cream than anything else in the frozen case at your grocery store. Well, our private label program was a mishmash. We had suppliers in different parts of the country, different labels all over the place. We needed to organize it, go to one supplier who could handle the business everywhere, negotiate the best deal, and make it work for everybody. What happened was Kemp's Marigold had the plant. They have enough plants in different spots in the nation they could supply everybody. They had great quality product, and they had a competitive cost. So we negotiated the deal. They also had incentive money. They had $3 million. They gave Kmart $1 million to make the change. You have to say no to your other suppliers and buy from them. They gave Fleming Retail Group $1 million because now Kemp's/Marigold is the supplier for the Fleming Retail Group. And they gave $1 million to Fleming Corporate for their private label group. So we had $3 million out there. Now what happened was, in the fourth quarter of 2002, our CEO was out there talking to Wall Street saying, here's what our earnings are going to be, 56 cents a share or whatever. That's a rough number. This is what we're going to earn this quarter. And he trots back into his executive suite and gets a handful of guys around him and says, now, look at our plan. What are we really going to earn? And they find it's maybe 20 cents a share. So there's a gap. How do you make up 30 cents a share, you know, in a very short period of time and hit the projection that you've given Wall Street? You know, if you don't hit it, that your stock's going to tank, and the people will lose confidence in your company. You know, your credit can be downgraded. There's all sorts of negative things that happen when you don't hit your numbers. You know, my response was always, well, let's be more careful with the numbers we give everybody. Nobody wanted to hear that. Our CEO was trying to turn this value company into a growth company, and he sent very aggressive numbers to Wall Street. So we had a gap, and what happens is Phil Murphy would come back from that meeting and say, okay, here's our part of what we have to fill. We need $30 million. Our group had to generate $30 million. So he goes, okay, there's about 12 of us in roles comparable to mine. What are all the deals you've got out there? And one of them that I put up on the list was, I said, well, we have this $3 million from Kemp's Marigold. It's a deal we've been working on for almost a year. The money's right here. It's cash. The money's there. But the question is, how do you account for that? If that's an incentive for a program that's happening now and in the future, how do you book that as income? And can you? The answer I was told 3 times was no. You can't book it as income. You have to take it as future earnings because it's for a program going forward. So Phil Murphy said, well, call it a rebate. Call it a rebate for business we've done best. We did a little business with Kemp's Marigold already. Not everywhere, but we had done some business with them. He said, just call it a rebate and have them sign a paper telling you it's a rebate. I'm like, well, that hasn't come up before. I don't know if that's right to do that. So I talked to the sales guy that I dealt with. Is this something we can do? His CFO got back to him and said, no, we really shouldn't do that. And after going back and forth, Phil Murphy desperately needing that money because he's got to walk back into the CEO and say, we've got you covered. We've got $30 million here that we can book as income and hit your earnings number. And at the end of the day, after going back and forth 3 or 4 times with our CFO, whose name is also on that, who is it? Shapiro? Mark Shapiro? Is he on top there?
Yeah.
Yeah. Mark Shapiro was the chief financial officer. At the end of the day, I couldn't get it done. I said, look, everybody's telling me no. And I went to Phil and said, no, Phil, they're saying it can't be done. The money's there, but we can't book it now. So I'm done. And he said, just tell Shapiro to talk to Marigolds about it. I said, well, okay. I said, they know something I don't, fine. So I had Mark Shapiro talk to Kemp's Marigold, their chief financial officer. The next thing I know, there's a letter in front of me signed by the CEO of Kemp's Marigold saying that this was some sort of rebate or something. And at the same time, their sales guy signed the agreement, the formal agreement, contract, that they were going to be our private label supplier. So, okay. I guess they knew something I didn't. Again, I was a year and a half, maybe 2 years out of working for a publicly traded company, and never had to get involved with anything like that before. We'd always just negotiated and moved forward. And there was never any incentive money associated with any of the deals I had done before, but now there was. And this is the way they did business. I mean, this was normal, and it still goes on today. Super Value is the major wholesaler that does business this way, and C&S Wholesale, there are others. I don't mean, I'm sure most of what they do is above board, but there is potential for danger. I signed that agreement, and we booked that money, and they hit their earnings that year. And the sad part of it is those earnings are also linked to the incentive. I mean, the bonuses that all the executives got were only available if you hit a certain earnings number. So again, more incentive for people in a big organization to do whatever it takes to hit the number.
And your options also.
And options as well, I mean, because that's all linked to the stock price. So the factors that make it so tough, it's really like a boiler room at some point. And really, when Phil Murphy came down, he got the 12 people that controlled all the negotiations and locked us in a room a quarter the size of this one and said, we can't go out till we figure out how we're going to generate $30 million. I shouldn't say he locked it, but clearly if you left the room, you left your job, and after having just relocated your family, and again, everybody in the room had relocated their families to this area because the whole company had moved. And not only that, but when you move, Fleming was very generous with their relocation expenses. They had this executive relocation program. If you couldn't sell your house, this company would buy it for you and then sell it for whatever they could and take the loss. If you leave the company within a certain period of time, you had to reimburse them those relocation expenses. Tens of thousands of dollars that I would have to pay out of my pocket if I left. And the HR person said, how are you perceived as a buying group out there in the world with Procter & Gamble and these other vendors that you deal with, and with some of your contemporaries, your other person groups? How is the Fleming group perceived? And my statement was that we were pirates. I mean, we don't, a lot of fun to hang around, but the guys around me would cut your throat at the end of the day. One of the guys next to me came up with this brilliant idea that, well, there's going to be shared savings now. Now that the vendors don't have to go to Troy, Michigan to call on Kmart and Louisville, Texas to call on us, they're going to save money. We're going to be easier to deal with. The volume's going to be greater. They're going to save money. So they sent out a letter that said, "Congratulations, you're now selling to and working with this new larger company, larger purchasing organization. It's only going to cost you 3% of your total sales for the year." That's millions and millions of dollars, and hope for the best. We put enormous pressure on them. We did over $1 billion in business with Kraft alone. One of the companies, obviously, that got fined is Kraft. I really feel sorry for the guy named Adams. You can read about him in the article. He was under enormous pressure because of the volume of business that they did with Fleming. Fleming was a very important customer to Kraft, $1 billion in sales. And if it meant signing a letter that $7 million or $10 million would get funneled to Fleming somehow over a couple of years, he signed it. There was still hope. I mean, when Kmart business came on, if everything happened the way the CEO wanted, it could have worked. I mean, look at what Sears did with Kmart. That worked when they just got together and made it work. But for us, it didn't. It just did not work. I could see it going bad. I was tired of being the company was using my credibility that I had worked hard for over 16 years with Aldi and doing clean business. They spent my credibility dealing with vendors now, where I would sit with somebody face to face at a desk, and I couldn't tell them that everything was going to be handled. I couldn't tell them that their bills were going to be paid and that those deductions were going to be repaid. My word didn't mean anything to them anymore, and I wouldn't. I would just tell them, I said, look, we're all in trouble. This is not going to work. If you want to get those paid back, I don't think you're going to. What happens then is if they still want to do business, and that's a big if, it'll be at a higher cost. Whatever you're taking from them, they're going to add back to the top line cost because they have to make money at the end of the day. And it's a really vicious cycle that, elevates the cost, makes Fleming uncompetitive in the marketplace. And at the end of the day, that $450 million in cash flow that Mark Hanson was so proud of, it went away because these vendors said, we can't handle the deductions anymore. It's not working. We have to put you on cash in advance. And that's a death note for a company. As soon as you start having to pay for product before you receive it, your whole cash flow goes away. One of the yellow flags that went up early for me, when I was running those 17 stores at Yes Less, the invoices went through the Fleming accounting system. They had a computer program that figured out how long they could stretch each vendor. I had no idea. Couldn't believe it. And it was really based on feedback. Well, how many days is it before this vendor will call me and ask for his money? Okay, it's due in 30 days, but I haven't paid in 45. When do I get that call from them? And they recorded it. Each time they would record. Okay, so this person doesn't care until 45 days. So they would just never pay until 45 days. If you weren't sitting on top of them, things wouldn't get paid. So yeah, they definitely stretched that as far as they could. But you think about that, a $15 billion company, that's $41 million a day in business that you're doing. And that's literally what crushed them in the end. When you can't buy products because you need cash in advance and your customers are clamoring for it, you're out of business. And Fleming literally went out of business because of that.
Yeah, so they could have been profitable.
Absolutely, and they were for many years. I mean, Fleming's was a 100-year-old company that had grown through acquisition and been successful up until that lawsuit with David's, quite frankly. I mean, they hadn't made money for a few years, but when Hanson was there, they reported their first quarterly profit in 4 or 5 years. And yes, they could have made money the right way. But his vision was to not just have a value stock, not just to be one that languished out there and just was kind of safe and comfortable. He wanted growth. He had come from PetSmart, Sam's, fast-growing companies, and as we looked at his history, he kind of did this at those companies too, unfortunately. And he never learned his lesson. I think he's learned it now. I was very surprised. I was surprised that people beyond Jim Thatcher, Al Abood, and Phil Murphy weren't charged. I will say that Al Abood, who was right next to me and another vice president, the whole reason he was there was because he was better at taking that money than anybody I ever met. He actually worked for Kmart, did it there, got in trouble at Kmart too. And I was astonished one day when I came in and he was in the office next to me. I'm like, Al, why are you here? Well, Phil Murphy had hired him. He apparently did such a good job taking money at Kmart that Phil wanted him on our team. And that was another red flag for me to get out of there as quick as I could. Yeah, I wish I would have stood up on the CEO's desk and said, look, this is not right. It's not right what you're doing to your own people, number one, putting me in the position where I have to, again, spend my credibility to try to save face with vendors. And for the vendors who are our partners in business, we can't be in business without them, for sure. We're destroying those relationships, and it's not right. I can give you one specific example. You'll notice one of the companies that got fined there is Kemp's Marigold, a dairy. They got fined, the CEO got fined, their chief financial officer got fined. Personally, they got fined as well as the company, hundreds of thousands of dollars in fines. That was a deal I did. I was very upset about that. My resignation letter to Phil, I worded it carefully. I was an English major in college before I started working in the grocery business. And one of the things we use when we analyze poetry, we talk about the gap between appearance and reality when somebody wrote a poem. And to me, that's what I saw at Fleming, was this huge gap between the appearance that the CEO put out there and the reality of how the business was run every day. And I told Phil that I could no longer willingly suspend my disbelief in the way the company was being run. And that was true. I said, because you would sit around and look at each other and see the way you're doing business, just shake your head and say, I can't believe this, I can't believe it. And you have to willingly suspend that disbelief to operate in that environment, in that culture. Couldn't do that any longer. It's too obvious. I mean, the facts were too obvious. The business model was not working, at least not the way the CEO was describing it to Wall Street, you know, that we're this big growth vehicle, we're going to be profitable. It was not. We were scraping for every penny. And another startup opportunity in New York became available. Once again, we could set our office, corporate buying office here in Chicago. So we got the team that put the Yes List stores, several of us back together to open another chain of stores in the Northeast. And I was excited about that. Negotiated a fair salary, no bonuses, no stock options, just it was a private company, it's one guy. The document that none of you ever want to see again and ever want to see your name on is this, it's my subpoena from the SEC to testify. So pass that around and make sure you never see one again. But the bottom line is that it's very easy to testify in front of the SEC. You tell them everything that happened, exactly why it happened, don't leave out any details, and it is what it is. Unfortunately, a lot of my testimony led to huge fines for the guy that worked right next door to me. His name's Alaboud. Here's the SEC exchange, what they charged each of those guys with. But I reported to Phil. Alaboud was a vice president, just like I was. He worked right next to me. If you don't live it and feel it, and you know, you would never know. You can read about it, but it just it overtakes your whole being at some point when you're right in the middle of all of that, and you see it kind of crashing down. So, like I say, at the end, it can make you stronger. And I certainly learned a lot. They also wanted to know a lot about the CEO. The one thing I'm truly amazed about is that Mark Hanson, the CEO, he hasn't been charged with anything. But it's very difficult, you know, and I have sympathy for the SEC as they go after like the Ken Lays of the world, or Bernie Ebbers from WorldCom, or it's very difficult because these CEOs never send an email. They have assistants and they do everything in meetings, and it's all verbal. It's never taped, but the direction is completely clear. They walk into the meeting, they come out with their marching orders. Each senior person has to contribute a certain amount of money so he can hit the earnings that he's talking to Wall Street about. None of that is in writing, other than the notes that the guys take who are in the meeting. So I had to say, yes, when Phil came out at his meeting with Mark Hanson, this is what he came back to us with, that we need to, you know, make $30 million here to hit the number. What you really judged on is what you do and not what you say, which is right in some ways, but for a CEO who never does anything himself, he didn't sign any documents except Sarbanes-Oxley. When Sarbanes-Oxley came out, we were all, and it's an interesting sidelight, we were like, is he going to sign it? Is he going to sign it and say, yes, I believe all this information is 100% accurate? And he did. He did sign it. And I always thought that that would come back to haunt him, to say that to the best of my knowledge, all these numbers are accurate, everything's justified, when he knew in his heart anyway that it wasn't accurate, most of it was manufactured. It's so interesting, when I used to hear Ken Lay, who would just insist on his innocence, you know, and just think, well, you know, what we did wasn't wrong. Yes, we did all of that. Yes, we created these subsidiaries and put the debt all over there, but that wasn't wrong. It wasn't wrong. It's like they convinced themselves that what they're doing is right. When I listen to some and read some of the quotes that Mark gave to Wall Street, that, you know, the deductions that we have with vendors aren't out of line. It's in the Wall Street Journal article. It's not out of line with what the industry standards are. It's a certain percentage of sales. It's always like that with every wholesaler. They convince themselves that what they're doing is right, that it's okay, and that that's just the way of doing business. There's just some sort of a mental illness almost when it comes to that. And the CEOs get it sometimes. It was frightening to watch. But I walked away from big bonuses just doing what I did. Other guys that stayed, even a few months after I was there, I was 2 months away, I think, from like a full year's bonus, which for them, again, was too generous, almost 80% of the salary. I didn't want it. I mean, who would want that? So I wasn't going to stay long. And I would have continued to do what I was supposed to do, which was to put together the best deals for the company that I could. How they were accounted for, I did kind of mentally separate myself from that. I had to. I mean, all I could do is what I knew was right every day. Negotiate for the best quality products at the lowest price. Simple. That's what I'm there for. How you want to account for everything else, I just kind of washed my hands of it and said, take it from there and go. That's kind of the mode I was in right at the time I left, and I would have found something else at at some point. That was not sustainable down there. The guy that had worked for Fleming for probably 27 years was a merchandise manager there, and he stayed right till the end. And you know, it was horrible for him and his family, knowing that this 27-year career he had, and probably his retirement, you know, account with the company, was all in jeopardy at that point. I mean, his wife actually had some mental problems, and she committed suicide the day they went bankrupt. It was really, really horrible. There are personal tragedies involved when things like this go on. It might have worked. If Fleming had ever purchased Kmart the way Sears just did, you know, maybe their stock would be $100 like Kmart's and Sears is right now. But that didn't happen.
Okay. Well, so let's go to the handout. You know, I think there's one question on here that I didn't. It's not in the video. I think I cut it out. This is why wasn't Anthony charged by the SEC? Anthony wasn't charged because he couldn't get that letter signed. Sometimes your failure is a big break. He couldn't get that letter signed. Had he got that letter signed, he probably would have been charged. And you know, and again, he's a journalism major, which isn't a very good excuse, but he has no idea about accounting or anything like that. So anyway, he wasn't charged for it. They actually found an email that basically said, "Hey, Anthony can't get them to sign this, so can you do it?" And yeah, so I mean, a narrow escape, really. But that because he couldn't get that letter. So he wasn't charged because thankfully he couldn't come to sign that rebate letter. And again, and this is a very strange case in that it's just so odd. It was a profitable company. It wasn't as profitable as they said they were, but it was a profitable company. You had a profitable company that went bankrupt within 9 months of the CEO giving a crazy estimate to Wall Street. And you had this 100-year-old company with tens of thousands of employees, Fortune 100 company, 100 years old, that went bankrupt. And they didn't, and it wasn't like they went bankrupt over 5 years. Literally, by the time they started taking these, you know, deductions from the vendors, it was a few months. It wasn't years, it was months. In a few months, this huge, profitable company was bankrupt. You know, once they got put on pay in advance, they couldn't, you know, they had no cash, they couldn't pay vendors, they couldn't pay their workers, they couldn't pay, it just stopped when they ran out of cash. A profitable company went bankrupt. And it was just one person. And they kind of found out as they looked past that in the past that this was not unusual for, you know, he had kind of done some of these things at other places. He was CEO of PetSmart for about a year and stopped paying the vendors, and then also did that at Sam's Club, and he was there for about a year, and then they replaced him. It was a kind of a pattern, and by the way, in both situations, he made tens of millions of dollars. You know, if you stop paying vendors and reduce your costs, you look very profitable for a short period of time. Stock price jumps up, exercise the options, and then the stock price tanks. You know? So anyway, it was a very, very unusual thing. But and here's the thing with Anthony, that, you know, I don't say a bumpkin, but kind of, you know, just not aware of what really is going on there. And he said, when he left there, people say, well, oh, you were in Fleming. Oh, were you there when they did the fraud? Yeah. Did you know there was a fraud going on? Yeah. Well, what'd you do about it? Did you tell anyone? Who? Tell the CEO. The CEO is the one doing it. You can tell the SEC in that too. But again, and one of the weird things too about this case is the auditors kind of got off scot-free on it. You say, why did the auditors get off? Well, auditors got off because they actually had the documents. The documents themselves were fraudulent, but the auditors relied on these documents as evidence of, say, the rebate and other things that they did. So, one of the things people always ask in situations like this, well, how can you prevent this from happening? And the real answer is you can't. And people don't want to hear that, but it kind of is. As long as you have humans running places, you'll get this. People doing with bad ideas, doing bad things. And again, in this case, there was a CEO who was very in charge, overbearing, it's my way or the highway kind of a person that is a danger. And so one of the dangers of fraud is there one person who runs the show. There's one person who does everything, and that's one of the certainly a sign that there could be a problem for that. All right, and another thing he's talked about that is kind of strange about frauds like this, and that is, well, the guy that was Fasto was the accountant, the controller for Enron, and so here, he actually took a plea deal. He was in federal prison for a long time, something like 11 years or something like that. And from his jail cell, he's talking about, giving interviews. And he said, look, I'm not the bad guy, I'm the good guy. Everyone wants profits. Management wants profits, Wall Street wants profits, investors want profits, everyone wants profits, and I gave them profits. I'm a hero. I'm not a bad guy, I'm a hero. Everyone wants profits, and I gave them profits. They get this mindset that somehow that's okay. Hey, if everyone wants profits and I give them profits, what's the problem with that? The fact that they were fictitious, and also as accountants, we don't make the profits. We record transactions. We don't actually, the accounting department doesn't make profits. We don't assemble cars. We don't, make television sets or anything like that. We account for it. So anyway, very weird mindset, but I think this video kind of gets you into the how does this happen? Well, that's how it happens. So, okay, what time is it? Let's go to any questions on any of these questions up here? You guys okay with them?
No questions.
Okay, all right. This then. Lost my screen here. What do I do here? I'm sorry. Here we go. Okay, so let's take out the chapter 7, and I think we'll do this one page just because there is a the Anthony video kind of leads into this page a little bit. So I think we did the 3 methods for documenting your understating internal control. And again, it's required that you get an understanding of internal control. You don't have to do testing unless you're going to rely on the internal control. So, you get these 3 different methods. You can use any one of them. You can also use more of them, but you do not have to use all of them. This is real popular with CPA firms. A lot of times we'll use this. And they'll also use the flow charts a lot. And I think I told you, when I was doing auditing, I like using the written narrative. CPA firm. Because you can, the written narrative you can give to anybody, they can look at it. So anyway, so that's the internal control questionnaire, flow chart, written narrative. Again, you can use all, any, or one of them, but you must use one of those to document your internal control. Okay. Risk assessment. This risk is assessed by at the following 2 levels. And the assessment, I think we already talked about this. The inherent risk. I'm almost positive we did this. Up here somewhere. No. We talked about inherent risk and control risk and detection risk. I think we did.
Yes, we did.
We didn't? Okay, well, I will. Did you say yes, we did, or no, we didn't? Okay, we can go over it again, or for the first time if I have it. Inherent risk is a risk that a material misstatement will occur. And control risk, which isn't spelled like that, is a risk that the client's internal controls will fail to detect material misstatement. Let's do it like this. Now, yeah, so this is all inside the client. So the client's inherent risk. So will somebody put in a wrong number into the system? Somebody puts in a $10 million asset, they put it in as a $10 million expense. Will that happen? And if it does happen, will it get caught? Will somebody say, wait a minute, this is wrong? Or something, there's something in the computer system that says they'll kick it out and say, you can't do this because it's wrong. So inherent risk is a risk that will happen. Control risk is a risk that the internal controls won't catch it if it does. And if the client doesn't catch it, then it's up to the auditors. See, detect is a better word. identify. So if the client fails to, if the client fails to catch it, then it's up to the auditors. So these first two are the client, and we only assess these. We can't change them. Detection risk we can change. We can do more auditing or less auditing evidence. So we can actually change the detection risk. And then this all flows into the audit risk. And maybe I did do it this time. The risk. The audit risk is the overall risk, and that is that the audit will fail, and that is that an undetected material misstatement. And we say undetected because if we detect it, and tell them to change it, they still leave it on the financial statements. We'll just change the audit report. So it is possible that you do your job, up to standards, and there's still a material misstatement because you find it and they put it on anyways. But saying, okay, if there's an undetected material misstatement will appear on financial statements. Now, at the certain level, we're basically looking at these two. What could go wrong, and what would be the impact of it. I'm not sure where I got this from. It's that looks like a textbook language. I probably stole that. But inherent risk is a risk that this material mistake will occur. I bored myself. Okay, so we're looking at really inherent risk and control risk because the auditors are the detection risk. So these are the auditors. So, we're looking at these two to say, okay, what could go wrong up here? And then we'll figure out what we have to do to find it. So you look for potential misstatements and identify the factors for those misstatements. And then you're going to design your test controls and procedures, substantive procedures, like we did in the sampling thing. Test controls, yes, no tests, and then looking for the dollar amounts. Now, this is at the individual account level. What could go wrong with cash? Let me change something here. So, what could go wrong with cash? What could go wrong with accounts receivable? Go wrong with inventory, etc. Oops. And when we talk about materiality and risk, usually this is what we think of. We think of the examples of at the cash level, is the cash misstated? Is the accounts receivable misstated, materially misstated? Is the inventory materially misstated? We're kind of in that mode usually. And when you're doing auditing, you really are a lot of times in that mode of looking at the account and is there a problem with this specific account that I'm auditing? Now, there is this financial statement level. So there's the assertion level. I should have put numbers or something on these, or letters. But anyway, the assertion level is one level, but then there is the financial statement level. This is the overall level, and this is the one that kind of leads into this Anthony situation. Are there risks because of a situation in the company? And the one down here, this is the one that kind of comes from the Anthony video. They had a domineering executive. Gave out crazy numbers and said, hey, fix my. Do we ever check about this? We must have. It says stop after it. Is that what you guys are trying to tell me? All right.
You went over it at the end of the class, but
Okay.
no, I mean, but this is quite useful because you're adding more. So
Okay. And internal control is kind of a funny topic because it used to be in the past, it used to be very, they would say, you'd have this list of controls that people would have to follow, which kind of fell apart because most companies, didn't do everything on those lists and they didn't need to. So they'd have, 27 things to do for cash, 38 things to do for accounts receivable and all that kind of stuff. And it really just, it's more of it's more kind of logic now, so it's, yeah. But anyway, so, but hopefully you see here, especially from that video, that at the financial statement level, what's the risk? Well, and you kind of saw in that video that there was all these different people that were involved in trying to make up this money. It wasn't just one account. There was many accounts of many different groups that had to, this one domineering, CEO, that they had to try to skew the numbers enough to meet his, what he told Wall Street. But anyway, these are some things here though that are indicators that there might be something beyond this, beyond just looking at individual accounts, cash and accounts receivable and all that kind of stuff. Beyond just looking at the cash, you also have to recognize these factors that could very much influence what that there could be a problem with fraud. And by the way, this one domineering executive, this is a very common one to have. Oh, look, down here I have this. Well, we already did this. Okay, so let's go ahead and stop and we'll take a break and let's say be back. About like 7:10. Sorry about the covering it twice, but yeah. So when you look at these things at the two different levels, there's the assertion level, which is what we kind of normally think about. You get an audit, they give you cash and accounts receivable, and they send you off. But also there is this kind of large problem, that if you have management that's incompetent or bankruptcy, declining economic conditions is one of those things that COVID really hit. And I had a friend who does bond ratings, and there's some of these companies that no one was prepared for it, and so there's a lot of these companies that look very suspect as far as how they think it could continue because of it, because the economy was, when COVID hit, no one knew how it was going to end, or if even now they kind of know. Okay, so we'll go ahead and come back at 7:10, and yeah. and we'll continue on. Okay, we'll go ahead and get started again. So this hand, I kind of doubt we're gonna finish this handout tonight, but we'll give it a shot here. All right, I'm just gonna copy this since we already did this. I'm gonna copy this down. Oops. Okay, so basically there's an inherent risk and control risk. These are both the client. And the auditors only assess these risks. Auditors only assess. And you cannot change, truthfully change the actual risk itself. Your assessment might change because maybe your assessment, wasn't accurate the first time, but you can't change it. You can't jump in the time machine and go back and change the inherent risk or control risk for the client. You can't go back and tell them, don't make this mistake or whatever. You can assess that risk as auditors, but you can't change it. Now, the detection risk so auditors control detection risk. So this is the only thing that we have control over. We'll assess these two because we want to know what to look for, and it'll help us down here to reduce that risk of the detection risk. And talking about risk, you always want risk to be low, right? I mean, as auditor, well, actually in life in general, I think you want your risk to be low. You're always looking for lower risk. And so the detection risk, the more you audit, the lower that gets. That because detection risk is the risk that an auditor will fail to detect a material misstatement. So, your failure rate, you want it to go down as on down, 20%, 10% is better than 20%, 5% is better than 10%, and so on. Getting it down low. So you can lower the detection risk. You cannot actually lower either one of these inherent risks. You don't have control over them, and they've already happened. If they had a control in effect in October, and you're at December, you can't jump in the time machine, go back and change that. You might change your assessment, but the actual risk itself, you have no control over. It's already done. So the detection risk is the one that we focus on, obviously, because it's the one we have control over as auditors. So this detection risk is really what we're talking about. How do we assess these other two risks so that we can set our risk so that it gets low enough that we can accept the audit risk? Okay. So there actually is a mathematical formula, and this has actually appeared on the CPA exam, I know, at least twice. It may have occurred more than that. I'm not sure if any CPA firms actually do this. We never did it when I was auditing. But you can actually multiply these out, that if your inherent risk times control risk times detection risk should equal your audit risk. So there actually is a formula, out of these. So down here, if we take this example, if the inherent risk is 50%, Control risk is 20%. Detection risk is 30%. We can multiply those all out, and that will give us our audit risk. 3%. So actually, is a mathematical formula. And notice that if you were to decrease this detection risk, the audit risk would go down too, right? We have control over this one as auditors. So if we change it down to, excuse me, 20%, reduce that audit risk, or 10% or 5% or whatever it is, we have control over that. We can get more evidence and get, more comfortable with numbers as they start going down that audit risk. These two we can't change. So these two we really can't do much with, because those are, we assess them, but in reality we can't change them. This we can change. The detection risk we can change. I probably should do that differently. So this is what we have control over. Yeah. I don't know what I'm doing here. Okay. So, the audit risk for this one would look like that. And again, they have had this on the CPA exam before. Okay. Relying on internal control. Okay, well, I'm sorry, again, I'm jumping around here. The one thing I should have talked about at the top here, and this is, it's not real new, but it's kind of new. This came about 10 years ago. We used to always just say that we're looking for material misstatements, whether it was fraud or error. We didn't really focus too much on it. Now, auditors are required to assess the risk of management fraud. So we are required to look for management fraud. So this is beyond just someone making a mistake, which does happen. We're supposed to look at management fraud, and especially in larger companies. One of the things that you will find is that a lot of times if the financial statements are misstated, that it is fraud. If there is, if they're misstated by, say, $150 million or whatever, that is usually a fraud. It just is, because if there was really $150 million mistake, someone would say, hey, why is my budget getting hit for $150 million? So it's one of those things that a lot of times when they are misstated, it is intentional. Now, it may be that they don't think it's fraud, or that they don't think that there's anything wrong. It's, that is a possibility. But a lot of times when financial statements are misstated, it is fraud, especially at that level. As you go down, smaller companies, they don't have the internal controls. Things could get, errors are more likely to happen. If they probably don't have a ton of controls. So the idea that controls would catch something is probably not. There's a possibility that they won't, a greater possibility that it won't. But like for larger companies, a lot of times, if they are misstated, it's not an error. It is fraud. Okay, so test controls. So if you're relying on internal control, obviously you plan the test of controls, perform the test of controls, and then evaluate the control risk. Now, control risk is up here. A lot of times you'll see in the literature, they'll almost, I don't say half the time, but a lot of the time, they'll sort of combine these two. The inherent risk and control risk, and they just call it control risk. You'll see that sometimes, but evaluate the control risk. And this is to evaluate your assessment, your auditor's assessment of the control risk. So really, so usually what you end up doing is you'll hold that. You'll work with a assumption about the control risk, what it is, what's acceptable, and all that kind of stuff. And then you'll go and do your test of controls, and then you'll reassess it. Okay, is the control risk higher? Is it lower? What do our tests tell us of the control risk? So we're going to use our results of these tests to update our assessment of the control risk. We don't actually change the control risk, we simply assess it, and our assessment might change, even though the actual control risk underlying it has not. It happened during the year, there's nothing you can do to change it. But our assessment of it can change. So we might assess it to be whatever, 3%, and maybe it really is 2%, or maybe it's really 5% or whatever it is. So we'll perform our test of controls, and then we'll reevaluate it. Okay, so control risk, design deficiency. The control wasn't designed correctly. So that's when you have somebody who has a test control, and the control itself was not designed to work. Let me zoom in a little bit here. So the control wasn't designed correctly. When I was at Navistar, we made trucks. So whenever you make a truck, people buy the trucks and they have to get insurance. And there were some people that it was difficult for them to get insurance. It could be that they didn't have any past experience with the trucks, they were new to the trucking business or whatever. So it made sense for Navistar to have our own insurance company so that we could insure people buying our trucks. To sell the trucks, we had to get insurance for them, and so that they could get loans. So we had our own insurance company, and this insurance company was set up basically to insure those people that maybe couldn't get insurance other places, and that we could. So basically, it was there to sell trucks, and it was actually profitable. it was one of the profitable areas of it. So okay, so here's the weird thing. This is where it became kind of strange, and that is, we had our auditors who were auditors that were familiar with usually heavy industrial stuff. They audited us. We built trucks. They'd audit other things similar to that. People that built washing machines or people that built cars, things like that. manufacturing of heavy equipment, computerized robots and all that kind of stuff. So that's the kind of auditors they were. When we got this insurance business, insurance companies are completely different. It's all paper. They have a big giant list of liabilities and a big giant list of cash, and the cash is there to pay off the liabilities, and it's margins are thin, and it's they're wacky. So one of the weird things that we had happen is that we said that we want the same auditors that audit our business, the truck making business, to also do the audit on the insurance company. Well, they had no experience in it, none. So they came in, and it's kind of funny because I ended up being there the second year that they were there, and looking back at the work, looking at the previous work papers was not very productive. They actually did bring in other auditors that were familiar with the insurance business to do the audit. But I remember one of the tests was to reconcile these two reports. These two reports that came in. And here's the weird thing about it. The reports came out of the same data coming out of the system. It was just the same data made two different reports. And one of the tests was to test those reports, against each other, which doesn't make any sense. The control wasn't really a control, and the test wasn't really, effective. So it was one of those weird things that, people running the insurance business and the people auditing them, it really wasn't up to where it should have been. Later on, not because, when I was there with the actual auditors that did insurance companies. But, but then there's things like that happen. And it's not that anyone's bad or anything. It's just, not familiar with it. Operational efficiency. I think I talked about this one time. The control wasn't used correctly. And I think I already told you guys this old boring story, but I started working at a bicycle shop, and they hired, I think, 3 of us. I was 14 at the time. I don't know if you can do that nowadays, but I was 14 and the other 2 guys were 15. And they got us working, they got us working the cash register, and we didn't know how cash registers worked. These are old cash registers. So you'd bring up something for the customer and it would come up and the tape would be hard to read. And the customer would say, this tape is hard to read. So, okay, so we go over to the next register, bring it up. Well, that tape's hard to read too. Okay, so we go to the third register, Well, you can imagine we get the same thing, rang up, 3 different times. We didn't understand that the cash register is there to make sure that everything that is paid in is registered and it's in the that they count it. So it looked like someone was stealing a whole bunch of money because every register was short basically. And one of the actual owners of the place finally looked at it and said, wait a minute, these are the same transaction running up 30 seconds apart on 3 different registers. And that's when it came out. Well, we didn't know what the control was. The control was fine. The cash register is fine. It wasn't the cash register's fault, but we didn't know what we were doing. We were, 14, 15-year-old kids and had no idea about internal controls, first of all, and second of all, like what a cash register even did. So the design is if it's designed correctly. The operational deficiency is if it's actually being used correctly. And those are 2 different things that, when you're looking at controls, those are 2 different things that can go wrong. Okay, testing controls related to relevant assertions. Now, generally the relevant assertions are for dollar amounts, but there are controls over different accounts that you can to help ensure that those dollar amounts are correctly stated. Now, the internal controls over those, you'll notice that a lot of times, especially for the big ones, occurrence, we have existence in here. We change this for a second. They do. The two big existence or occurrence and completeness, these are the two big things we have going into every account. And so you'll notice that the controls over them are shockingly similar. Segregation of duties. Did I go over the segregation of duties?
I don't think so.
Okay. I apologize for being so flaky. I got a night class. It's a graduate class, but many of them hadn't had any auditing class. So I'm kind of altering their class to be similar to this class in some ways, and I'm not sure what I've covered. And I just covered it because it's let's see, I had the first class, so I'll do the next one. I'll do segregation of duties. It's probably later on in the handout. Well, if it is, it is. We'll do it right here. Segregation of duties. You remember the segregation of duties by car. Custody of assets. I'll go over this in a second. Oops. Authorizations and record keeping. Okay. So these are the things that must be segregated. CAR. So custody of assets, who has the assets, authorizations, and record keeping. And let me give you an example. Let's take accounts payable. Okay, custody of assets. Now, people in accounts payable actually don't write the checks. So custody of assets, so you're going to send out these checks of cash to pay off these accounts payable. So who has the cash? Is the asset, and the control of it is the treasury. The authorization comes from the accounts payable department. The accounts payable department will match up all the documents they need to match up, and they will authorize the payment. So the treasury department doesn't authorize they have to be told by accounts payable, here, pay this, this vendor X amount of dollars. But the authorization comes from the accounts payable department. And the record keeping is done by us. The accounting department. So these would be, the segregation of duties that you'd have for, this is say for accounts payable. Let's do another one. Let's do for inventory. Oops, that's nice spell. So for inventory, custody of the asset is going to be probably the receiving department, at least at first. So inventory, we order it, it comes in, it'll be in the receiving department. And then maybe it goes on to the stores department. It could be stores or warehousing, it could be, once it leaves the receiving department, it'll go into some other one, someone else who's authorized to have control of the assets. Authorization is the purchasing department. So the purchasing department, they're authorized to make purchases. So they'll purchase the inventory, it'll come to the receiving department, will have control of it. The record keeping will be us again, accounting. And, so these are all activities that you need to keep separate. And the reason why you need to keep those separate is, for instance, someone in the purchasing department, you say, well, doesn't the inventory go right back to the purchasing department? Well, the purchasing department is authorizing them, and it comes back to them, they can order anything. Right? If they're the ones that are, they can order a Ferrari. It's not in the purchasing department. Hey, how about that? Everyone in the purchasing department has Ferrari. That's kind of strange. So anyway, you need to keep these separated out. And when you do run into a problem, a lot of times it's because these duties are not segregated. So segregation of duties is actually very important, especially the larger companies. Now, there is a problem with smaller companies, smaller businesses. So, for instance, if the office only has 2 people in it, well, there's no way you can do this with 2 people. And even with 3 or 4 people, it can be difficult, to have, for all the different accounts, all the different things going on, to have these completely separate. So it can be, so segregation of duty is one of those things that is, especially at the upper levels, our larger businesses, is incredibly important to have these be separate. And again, when you run into a problem, especially things like embezzlement and all that kind of stuff, a lot of times you find the problem is in here. These 3 areas that or should we say segregated. By the way, this is also sometimes called incompatible duties. Oops. So this is also known as that. And you can see these kind of interchangeable. So incompatible duties are, kind of the same thing. Duties that you shouldn't have one person doing 2 of those. So we talk about existence or occurrence. Segregation of duties is one of the big ones. And that goes through all of internal controls, segregation of duties. You don't want to have people have any of these overlapping. I'm going to add one more on here that you'll see sometimes. Reconciliations, you'll sometimes see added onto here. Most of the time, reconciliations are done in record keeping, but sometimes you'll see people list, different groups will list this separately. You don't see it all that much. It's usually part of record keeping, but sometimes you'll see it listed separately. So anyway, pre-numbered, serially numbered documents. It's kind of funny, you know, pre-numbered, you will, you know, of course, they're going to be serially numbered. You know, I'm not going to go 1, 5, 8, 3, 7, 8, you know, random numbers, but serially numbered. And you know, when those things are, when those are serially numbered, you can account for all of them. So if the purchase orders are serially numbered, well, you should be able to account for all the purchase orders. You know, it's one way of making sure that you have all the purchase orders the same number. If there's one missing, then there could be a problem. Same with sales orders, same with whatever else you want to, you know, whatever other orders you want to talk about. Excuse me. Ah, man, am I boring. Okay, daily or monthly reconciliations. And again, this is one of those things that is usually done by accounting. Accounting does, like, saying the bank recs and all that kind of stuff. Those are usually done by accounting, but if they have it out separately, the reconciliation of the records. For example, let me give you an example of one of those. Credit sales reconciled with additions to accounts receivable. Right. So credit sales reconciled with additions to, so, you know, as if you want to see what, if you have a certain number of credit sales for the month, those are on credit, not cash, right? Credit sales. So that's when someone owes us money, they haven't paid us yet. So those credit sales, you can actually look at the additions to the accounts receivable, and those should be the same, right? The credit sale, someone buying something on account, and the accounts receivable should go up by the same amount for all those credit sales. So you look at the additions to accounts receivable, and it should reconcile to the credit sales. So it's not just for a bank reconciliation, it could be for other things too, like this. Okay. And let's do a couple of these now. I think we'll do these multiple choice things, and they're kind of multiple choice, but and then we'll see what, and then we'll call it a night. Okay, which transactions will usually have a higher risks? So which one of these? I should have worded this differently. There's actually one that there are two of these have higher risks.
Would it be B and C?
Yep, it would be B and C. Non-routine transactions, so something that's strange, and estimation ones because they're estimates. And sometimes estimates are, you know, can be manipulated and or done incorrectly, you know, that when you don't have something that's hard numbers. Routine transactions, you know, for instance, you know, sales, you know, Walmart in any given store probably has thousands of sales a day. It's a routine transaction. Those are usually fairly low. The transaction goes to the cash register and it's, all those are combined and it's going, it goes into the general ledger and blah, blah, blah. Routine transactions are usually, they're usually the problem. It's those strange things that happen that are a problem, or those things that are estimated. Auditors perform tests of controls for all the following except those all look like good things, but there's one that it really doesn't, in that we don't care about it, but we don't test for it.
Letter A.
Yep. Yeah, if the control is inefficient, we don't worry too much about it. I mean, and not that we wouldn't, if we notice that we wouldn't tell somebody, hey, you have 3 people doing this and you could really just have 1. But as long as the control is effective, this is really what we're looking for. Is the control effective? And we're looking for controls that will detect or prevent material misstatements. Detection is after the fact, and prevention is, I type in something into the computer and it says wrong, you can't put that in. It prevents me from making a mistake. Okay. Oops. Audit procedures to test the effectiveness of internal controls include all the following except
Letter A.
actually, we will use letter A. This one. This is kind of I think I pulled this right off of a CPA exam question. This is, we have 2 different, this goes way back to what we were talking about earlier. There's testing of controls. There's understanding of controls and testing of controls. So this is an understanding of it, not a testing of it. So the rest of these, you're actually testing it. And inquiries of clients' employees that you testing the controls, part of it you'll ask the employees, well, what do you do when X happens, and have them tell you what happens. So you actually do, some of the testing will actually be done by inquiries of the client's employees, and that you asking them, what their knowledge is about the controls, and you might take a handful of employees and see what they say. That might give some kind of indication of how many people are actually doing what they're supposed to be doing. But in inquiries, I'll say both of these, because it really depends on what you're asking them about, and how you're actually doing it. But these 2 are certainly, these other ones are very important. And the most important one here, I should say the most persuasive one here, is this. Yeah, inquiries could be part of more leaning towards the understanding. Very good. Okay, test controls allow the auditor to complete which of the following items. There's one there that's kind of a strange one that there's some background to. Okay, everything on here pretty much determine the timing of substantive procedures. They can. The substantive procedures that are done at, say, year end are more effective than those done to year. So if there's probably the internal controls, you can insist on doing the, say, inventory at year end. Revise the risk of material misstatement, could do that. And it will definitely do these two. This one is the odd one. A lot of audit relies solely on internal controls. No, you can't do that. You can rely solely on substantive testing. You can't do it the other way around. You can't rely solely on internal controls. You have to do some testing of the dollar amounts. And your initial reaction might be, well, duh. But believe it or not, back in the days of Enron, there were many articles written by auditors that said, well, look, if the controls are all working, you don't have to worry about the dollars. The dollars will be taken care of if the controls are all working. So you really only have to audit the controls. If the controls are working, then everything's working. And obviously that doesn't take into account that you may have management fraud. Yeah, because management fraud can manipulate whatever. So if you're wondering why that's in there, and it might seem like kind of a strange thing to even consider, they actually did consider it. The whole idea was these large companies, the dollars are so giant that it doesn't really matter what the dollar amounts are, but as long as these controls are working fine, then the dollars amounts will take care of themselves. I'll look at something real quick. And there you go, right there, the inquiry. Yep. So let's go back down here. Good catch. Inquiries of clients, employees, give you an understanding of internal controls. Question? Okay, let's stop here. Yeah, stop. Okay, so what I'm going to do is put the Anthony case in to get turned in, and I think before I talk, I should check. I think the sampling case is due. Let's do this Friday. Okay, any questions?
When do we have to submit the questions for the Anthony case?
Oh, that would be, I'll put it in right now as we speak. Anthony video, so let's get the date for that. That would be, I think it's the 22nd, but let me check and make sure. No, it's yeah, 22nd, so Friday. I should do this after everybody. Why you guys are still here. Do 4-27, and the possible points are 100. Limited attempts, highest grade. Yep, so it'll be next, not this Friday, but next Friday. Actually, we're getting close to the end here. This is what, week 13, is it? It was week 13, so we only got 14 and 15. Getting down to it. Okay, so Anthony video due Friday, 4/22. Some question on
No?
that? Okay, well, have a good evening, and I will talk to you guys in a week's time.
Good evening. Thank you.
Good night.